Hey everyone, today we're going to take a look at Inditex again. This time we will look at it from a quantitative standpoint and we will make some estimates about growth rates for the future based on profit streams for the future. Let's go. Where does Inditex growth in profits come from? If you view Inditex business from a high point, they mainly have two business segments, online and physical. Online sales grow faster because they have been rolling out websites during these years. So they have been investing a lot in spreading those websites around the world. Uh, Also, because people are shopping more online increasingly over the years. If you take a look at the written posts, you will see a chart, and in that chart, you will see part estimates, part firm values of online sales growth and physical sales growth, and also total sales growth for Inditex. And it is very interesting to see that physical sales growth is 10% for 2016, 5% 2017, 1% 2018, 6% 2019, and minus 43% 2020, because we all know the reason, so Corona. But online sales, because they have been expanding, and also the customers are buying increasingly more online. We see growth rates of 24 up to 65%, and this 65%, this is true across most fashion retailers, big brands, Nike, for example. Um, the online sales accelerated precisely during the Corona pandemic, the beginning, and this is because we couldn't shop physically, so we we instead shopped online. But this chart alone doesn't justify anything because this is just historical data. Um, we can see the growth even in physical stores, but where can net income growth come from for a company like Inditex? And here's some sources of revenue. The first one is volume, so selling more things, and that can come from two ways. So more people buying, so more users shopping Inditex products, and can also come from people buying more. So the same people buying more items. Then you have pricing. So if you sell the same product but at a higher price, that will also increase net profits. Then you have product mix. So if you sell a T-shirt and you make a T-shirt, a premium T-shirt with the same style but at a higher price point, you have a different product mix and you will sell more because premium products have better margins. Then you have cost reductions, um, and that one is mostly self-explanatory, but we will dive into it later. How can they do cost reductions? And another one is profiting for a longer period, because when you buy a company, you know this, you know that you are buying the present value of all the future cash flows. So if the company profits for longer, that's better. If you stay invested for that period of time, and we are investing for the long periods here, so that's good. So that's another source of revenue, profiting for longer. So Inditex is better off profiting for 20 years than it is profiting for 10. That's what I mean for by profiting for a longer period. As we will see, not every one of them is measurable, and we can see this happening with other companies. For example, Facebook with their ad relevance growth. So if an ad becomes more relevant to you, you are more prone to click, and that is better for Facebook, the advertisers, the users. and that is not measurable as far as I can see. But Inditex has also sources of revenue that aren't measurable. But let's start with the first one. The first one is volume as a revenue source. To have more people buying, we need to either have more people coming into the physical stores or increase online traffic from new users. And the latter, although important and dependent on a stronger brand, is unmeasurable to outsiders. The former can be estimated. So it is not possible, as far as I know, to know the growth in users from online shopping. They of course know, but they don't share it with us on the 10Ks. Inditex physical store strategy since 2012 has been to reallocate stores to central areas, and that's a plan that they call Store Optimization Program. They have quantified the drawback of store closures because if they are reallocating some of them, they have to close stores, so they expect to lose some sales. But they also expect to recoup most of those revenues with online shopping or the stores that they open instead in those central areas. The immediate impact of those closures is a total of 3 to 4% of profit before taxes, so EBT. And this is numbers by Inditex, so they told this in the 10K. Because population is increasingly moving into urban areas, there's an upward pressure in foot traffic where Inditex stores are. And you have a chart based on World Bank data, so we can say that is a fairly secure data to use. And you will see that the rural population percentage since 1960 has decreased from two-thirds of the total world population to only about 40% of the world population. And urban population is the other side of the coin. So it is now over 50% of the total population, and it is rising at a decreasing rate, but at around 2% CAGR per year. So compound annual growth rate. This means that if you consider this data to be reliable, and that means that urban population growth defined by their standards, and they have clear standards about what's urban and what's not. And yeah, if you assume that the changes of their standards didn't affect this definition of urban population too much. So if the data is reliable to us, we can say that there's 2% more foot traffic in urban areas each year. And that means 2% more potential customers because Inditex is mostly where foot traffic is highest within each urban area. That's their objective. And they have been doing this for about 10 years now. And this is that change is almost finished, by the way. Um, this macro trend should help revenues grow at a 1 to 2% CAGR and help advertise the brand organically because if you have high foot traffic, you see their brand lots of times. And this is not new. They usually put themselves near other high fashion brands, and that also helps with the brand building. Um, Especially Zara is the most known one, and also the one that accounts for most of the revenue. So this helps the brand to grow organically. So the first one was volume, then we have pricing and pricing power. We already mentioned SINT in Inditex qualitative analysis, which you can check on the written post, and that is at stockpickinginsights.com, where this post is too in the written form. And SINT is a natural consequence to RFID tagging. If you know where every product is at all times, it allows you to sell it physically and online without making the mistake of selling the same item twice. So it is a great starting point to manage the inventory better, but that's not where it ends. The biggest advantage of SINT is to have the same item displayed in multiple places because that increases the chances of that item being sold. Because um, if the same item is in two places, uh, there are more potentially more eyes looking at it, so there's more chances to buy the same item, and this helps to keep inventories low. And if you take a look at the sales inventory of Inditex and compare it to other fashion brands, you will see that Inditex is among the lowest of the industry, and maybe only Boohoo, the UK online, fully online fashion brand, comes close to that. Also, if my items sell more easily, there is lesser need for discounts and average selling prices stay closer to full price. So there's less need for discounts. This is also an advantage of having the same item in multiple places. You also have pricing power, and the question we should ask is: Will Inditex be able to rise prices at the rate of inflation or more? All we can say is that we see higher price points at Zara stores, which again accounts for 70% of revenues. We see those higher price points from several sources, and you have an example. You have a link on the written post about that that focus on loungewear products. They purposely anchor themselves to high fashion origins, and they charge premiums based on it. Um, you can see this behavior by looking at where the physical stores are. And all this helps to say that Inditex has the power to keep up with inflation because of their brand. They have a good brand, Zara especially, because it's the most known one. Inditex sells the image of affordable compared to high fashion brands. It is very well known and sought. If you take a look at the last 15 years, they have 3% average like for like sales growth. And I expect them to keep up with inflation. For example, Primark, because it competes for the low cost, it would have a harder time raising prices. And the same goes for Boohoo. Um, but to say that Inditex has the pricing power of luxury brands, that's far fetched because um, Nike, for example, has much more pricing power than Zara because they have a much stronger brand. The competition is too fierce for Inditex to have that power today, but who knows how the brand will develop in the future. They may be able to do so for short periods of time, those price increases, based on some distribution advantages that boost service quality, but it is not fairly long term argument for inflation price increases. The third source of revenue is product mix. Product mix is also one of the sources. If you face a choice between a regular shirt for 20 euros and a shirt from sustainable and or recycled materials for 23 euros and end up buying the eco-friendly one, they just increase their revenues with better product mix because um, the difference between the shirts from a supply chain perspective is raw material, um, and the design and the manufacturing process is largely the same. You still have to design the shirt, dye it, cut it, and outsource the sewing and the accessories, the buttons, zippers, as you would with a normal shirt. Um, but there is not that much difference. So the premium that you get to charge on the eco-friendly or the sustainable product will likely be better for the product mix and end up increasing net income. So same costs, or not exactly the same costs, but around the same costs, but higher revenues and operating margins. Now, how do you estimate revenues from better product mix? You don't. Fast fashion retailers don't plan most of their product offerings for the season, so it's not like Coca-Cola planning to produce an hypothetical premium packaging in order to boost product mix revenues. But does this mean that product mix is irrelevant? For a quantitative analysis, I would say yes, but for a qualitative analysis, definitely no. They historically have more full price sales than the competitors because I rotate the product offerings faster. Um, and this creates scarcity and urgency, reducing the need for discounts. So, this is one of the reasons why Inditex is well positioned to benefit from product mix revenues. The other one is that Inditex gathers more customer feedback than competitors and from more sources too. So, because they have physical stores and online stores, they have various sources of different types of data. The main reason is size. They get to collect more data because they have more revenues, more stores, more years operating, so they have a more known brand. So all of that helps collecting more data. Then you have the culture of getting feedback, originally from stores, and the presence in both online and physical. For example, some competitors are only operating online, such as ASOS and Boohoo, so they don't get to collect personal feedback from stores. Inditex growth in profit from cost reductions. The store optimization program is set to make Inditex less capital intensive. Here are some of the positive consequences of that. The first one is less inventory overall. If I merge two stores by absorbing the oldest one, the worst located one, I don't need to have inventory in two places anymore. So that reduces inventory instantly. Then you have less fixed assets and depreciation expenses and less headcount too because they have less stores, so that will be reduced. And thirdly, you have lower inventory costs. Because my inventory is more centralized, I now don't need as many trips as before to fulfill the store orders. Inventory costs factor in those transportation costs, so that will reduce cost of sales because that's where inventory goes. The effects of these changes are already in place though, due to near completion of the program. So we are already seeing the effects of these changes, and we will thus ignore it when talking about future growth. But one specific item is headcount savings, and headcount savings is very important when it comes to cost reduction. And they have been running their business with proportionally less people. So sales are growing, but headcount is not growing as fast as sales anymore. And in fact, if you take a look at the chart that I have on the written post, you will see that they go hand in hand, but the gap is getting closer up until 2018 when it reverses. So sales goes up, but full-time employees or headcount, it's the same thing, stays mostly flat. As you can see, the gap between headcount and sales has been closing and even reversed in 2018. If you take employees per million euros of sales and you see how has been developing, you arrive at a -2% 5-year rolling HR. So that is what I was talking about on the chart. And 15 years ago, they had 8.5 employees per million euros of sales. So each one made around 125,000 sales, was responsible for that indirectly. But that number came down from 8.5 to 6.8. And that means that they can make the same sales but with less people. The absolute number of employees went up, but that's also because sales went up. The exception for this is 2020 with the pandemic, because they had to cut costs in order to stay profitable. Um, but again, the headcount is not growing as fast as sales, and that's a good sign of headcount reductions. Um, it is a good sign, but we also have to be careful, because this is only a good sign if you trust the management, because account reductions are easy to do, but they may not be good for the long term because they may deteriorate the business. For example, if you fire the most important people in your business simply because they are taking too much money from it, they are too vital and should be better paid. So that is important for the long term profitability of the company. So that makes them stay in the game for longer. But Inditex has what I consider to be a good management, and I trust their way of managing. So this is not concerning, and this looks like the product of operational cost reductions. The effect of headcount reductions is direct. You can see it in income statements. Um, because they operate with less fixed costs, they get higher margins as a result. And in fact, we can point to how they are doing it. The driver is operational efficiencies. Inditex is always striving to make their business less labor intensive. You have examples, for example, robots such as Cleveron 402, and that's an automatic dispenser for click and collect. And I mean buy in store and buy online and pick up in store. They bought a robot for that. That helps because you don't have to have the store clerks picking the items and giving it to the customer. The customer can do it themselves. Another machine replacing human capital is the self checkout unit. So you don't have to pay with the assistance of a human. It's like grocery shopping. You can do it with a self checkout unit. All these automations are far from globally delivered, and new ones are expected to come in the future. I expect headcount relative to sales to keep decreasing at 1 to 2% CAGR over the next 10 years. Considering the average cost of each employee, this should boost net profit for around the same amount, 1 to 2% CAGR, so compound annual growth rate over the next 10 years. And finally, we have profiting for a longer period. And this subject deserves focus because it is very important if we are investing for the long term to have a company that profits for a long period of time. And let's start with an hypothetical example. If Inditex grows at 8% for 5 years and dies on the sixth, you made 50% at most. And that's if you sell at the highest point before the company goes bust. You can also make zero to negative return if you sell too late. And on the other hand, if Inditex grows at half of that, 4%, but for 20 years instead of 5 years, you will double your money without moving a finger. So it is, for the long-term investor, it is a delight to buy a company that it would be it would be great if we knew that it will stay operating for 20 years, because that means that if the company is good, you most probably don't have to worry much about it. So it is almost passive income. Inditex is better positioned to be the latter, so they are better positioned to be profitable for long periods of time. But we shouldn't expect too much growth. But we will consolidate all these little topics that we've been talking about in a bit. They are not banking on an industry shift, unlike, for example, Facebook is getting a big tailwind from that. Not they are banking on it, but they are growing a lot from it. And I'm talking about the shift from offline to online advertising. You also have, for example, Alphabet taking advantage of that. And Alphabet is also taking advantage of clouds, so physical servers going to online. The two industry shifts in one company, but Inditex is not banking on it. You have consumers increasingly spending online, but that doesn't necessarily mean that they are spending more overall, because um, they are they may be spending the same, but instead of spending physically, they are spending online. Um, an Inditex shareholder expects Inditex to do the same in 20 years. We should expect them to be reacting to consumer trends, but more efficiently than today. And so that means that they most of their growth is likely to come from cost reductions. It's more bond-like than growth-like. The key factors for longevity of Inditex business are brand strength and operational advantage. The first one creates a demand for their specific products, distancing the competition. If I'm looking for an iPhone, the competitors are already at a big disadvantage, because I won't be looking at them the others as much. The second one, operational advantage, ensures higher profitability and better customer service. If I deliver faster and cheaper than the competitors, or make online returns less of a hassle, I will more likely turn to Inditex. So, cost reductions can also make the competitive advantage more durable and better. There is plenty of little differences between Inditex and the competition. Uh, Uniqlo, Uniqlo is, if you don't know, the biggest brand from fast retailing, and fast retailing is a company similar to Inditex, but um, they don't manufacture their own products, and also they don't ship to Spain nor Portugal, um, so they don't ship globally. Boohoo, for example, makes you return products by shipping them to the distribution center, while Inditex allows you to drop them off at Celeritas points, or at the store for free, or you can even schedule with their transportation businesses, and they will pick it up at your house for free. So they have those advantages. Boohoo also charges $7.99 at the time of writing for international shipments, and that number is lower for Inditex. H&M is coming in aggressively with free home delivery. You just have to make an account. They also have 100 days to return items, so they are um, doing more aggressive campaigns than Inditex. They make an even better and possibly not sustainable delivery proposition than Inditex. So there's plenty of little differences between the competition. If we put all of this together, we get foot traffic revenue growth, 1 to 2% CAGR, and we get headcount reductions, 1 to 2% CAGR too. So there's not much measurable growth here. Um, if you take another look at like for like sales, and they define like for like sales with stores operating for 2 fiscal years, and I separate like for like um, physical from like for like online, because they in their like for like they don't do that separation, but we should do it because we want to see how is physical and online going separately. But even if you do that, um, because and another point is that because online is growing so fast, like for like sales look better than they may be. So that's another reason for you to separate those two, physical and online. But even if you do that, you'll see that physical stores are healthy and they look higher than the 2% KHR from foot traffic. And that means that um, that may be because of brand strength and an unmeasurable qualitative aspect that is an unmeasurable qualitative aspect, and it is a revenue driver, but we can only see brand strength, the effects of it in hindsight. So like for like sales look better than what we are forecasting, and they may stay like this in the future, and that is due to brand strength. Due to the adapting business model, we can expect Inditex to be around in the next 10 to 20 years, and that is not a light thing to say because not many businesses are that clear to be operating for those long periods of time, because so much happens in 10 to 20 years. The internet has been around mostly since the 90s, so that's not much more than 20 years, and that is a rare thing in itself, a company to be operating that long. And um, growth mainly will come from optimization and brand strength. And I am extra unforgiving with the EV ratio at which I go in with Inditex because of that. So because I don't expect growth, I don't pay too high of an EV compared to what is considered average for Inditex and for the industry. That's it, guys. If you like the content, please share it. It helps with your long-term investors. And if you'd like to check the written versions, you can also subscribe to the newsletter, and that's at stockpickinginsights.com. And we'll see you next week.